Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, May the 19th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios. Therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. A little bit of economic data that we've had out. We did get Great Britain's retail sales come in a little bit higher than expected at 1.3%, was expected at 0.6%, and last month it was actually a negative 0.5%, so better than expected on that front. In the States here, we got Philly Fed manufacturing, which is one of the more widely looked at Fed manufacturing data points, and it came in at negative 1.8%, but it was expected to be a positive 3.2. So that was quite a big miss, but in line with last month at negative 1.6. So that was a pretty big miss for all intents and purposes. Then we also had unemployment claims come in line with expectations here in the States. We also got the natural gas storage coming in slightly lower than expected at 73 billion cubic feet, was expected at 75 billion cubic feet, so slight drawdown there, maybe due in part to the fact that the Midwest has been seeing cooler than normal temperatures, so people have been keeping their heat on a little bit longer and doing more of a drawdown there. We also had New York Fed Governor Dudley speaking. He is usually a pretty big dove, so he was talking about how he was surprised that the markets really weren't pricing in the probability of a rate hike at the June meeting. So that caused the overall markets to even slump further. First move down was on the Philly Fed number, then the markets kind of regained a little bit, and on his question and answer this morning, it really sold off again and started reaching new lows thereafter. On to a couple of things here in the markets. As you can see here, crude oil is starting to pull back a little bit, down $1 on the day. We talked about this in daily market commentaries probably several times. Crude oil really needed to get up and above $50 a barrel to push higher, to get the bears kind of on their heels, and I felt like we would trade up to the 60s if that were to happen. I still see that if we trade and settle above 50, that would be the next point of contention for the market. It would probably rally up there relatively quickly. But having said that, the bears did defend that $50 a barrel area, and as you can see, we're starting to come back down, so I could easily see us trading back down to the $45 a barrel area. So keep your eyes out for that. I haven't done anything in this market yet, but I'll have to see how that goes. On to the NASDAQ. Looks like we're really right on the lows of the day here. As you can see, /NQ down 50 points on the day. When I get into the E-mini S&P breakdown, you'll be able to see how the market has reacted to the more data dependent points that we've seen. Here is the E-mini S&Ps /ES down 16 points on the day, really pushing a lot lower. This is the value area for the time, and for the volume is right up here a little bit higher. One thing I wanted to note is that the market profile really has a tendency to mirror, in a sense, the Fibonacci retracements. And the reason why is probably, for one, so many people look at Fibonacci, and two, the Fibonacci levels kind of show up on the market profile. But having said that, they are still very powerful because it really gives you, the market profile is very powerful because it gives you more of an in-depth look at just more than lines in the sand and the candlesticks, it really tells you where people are putting their money where their mouth is. So it really reaffirms at some points where these Fibonacci levels are. So it very well looks like the E-mini S&Ps having really slumped down and broken below what looked like a very strong support area right in here that was lining up with the volume area here. As you can see, this line right here, which was the last couple of lows, that was a support level, pretty strong support level within these Fibonacci levels as well, and we've broken below that. That is, it has been broken now. It's really dependent on whether we settle below that or not, and if we do, I could easily see the E-mini S&Ps coming down and testing this Fibonacci level, which coincides with this peak in the market profile. Onto the breakdown of the E-mini S&Ps, as you can see here, this was on the Philly Fed data points. Market really sloped and then kind of tried to recover heading into Dudley's speech. More people thought that Dudley is a dove, so if he was going to talk dovish, that maybe a limelight would be that he would say that there wasn't going to be a tightening coming, but he sure enough said that the tightening was very realistic, if nothing else. On to the trade that I did yesterday, and on those FOMC minutes coming out, I really took the opportunity to cover this GDXJ trade that I've had on for quite a while. It really was in my face for the better part of this whole trade, and it was in the May, so it's expiring tomorrow, and I just didn't want to take that risk going forward once I saw it turn slightly profitable, basically a break even for all intents and purposes. And I had on the May 34 straddle, and I originally sold it for $3.65 as soon as that went positive, and I covered it for $3.50. You know, it was looking a lot better earlier this morning, so if you had the opportunity to cover that this morning, that would have been a great opportunity, but it's right back to where I covered it yesterday. So, you know, I was kicking myself a little bit this morning, but at the end of the day, it could have just opened up and rallied straight up, and I would have never had the opportunity to cover that. Onto a trade I added today, which was Biogen, ticker symbol BIIB. And with Biogen, just looks like it's trending nicely sideways here. It has no discernible direction, so I decided to go into, and I figured this was acting as a pretty strong support. It came down there and tested it twice, and this is going to act as a nice resistance area to the upside. So that to me looked like a pretty good opportunity to put on a strangle. So I went into Biogen and did the June 230 puts and the 290 calls to create that strangle. Sold it for $4.85. So did that small. It's a big stock. The markets in there are pretty wide, but I just went into the mid-market and left it there. Felt that if I got hit on it at my price, then that was where I was going to do it. So I did have to work that for quite a bit of time, but I did end up getting that trade off. Walmart, I tweeted this out yesterday at Wolfman's blog. You can follow me there. I tweet out some of the trades that I do late in the day. Usually I try to get these market commentaries done early on, but afternoon, last hour or so is usually when I like to put on my different earnings trades, so keep your eye out for that. And I tweeted this one out too. I did the May, which expires tomorrow, because I want to get that volatility crush and the theta decay happening really fast. So I did that in the May, sold the 58.5 puts for 29 cents, bought them back this morning for a penny. Now, why did I sell those puts? I've been talking so bearish about these different retailers and how I don't think they're doing very well. Well, Target came out and really slumped off. Walmart followed that, ahead of their earnings. So it, to me, it looked like Walmart had already priced in the worst case scenario. So even if they did come out with worse earnings, I didn't feel like they were really going to sell off that much more, because they were already pricing in bad earnings for the most part. So I took that contrarian point of view and decided to sell some puts because I was able to get down here really low and sell these 58.5 puts way down this way. And sure enough, they came out with better than expected forward guidance and better than expected earnings, so the market blasted off higher. So that was a nice contrarian play. That's about all I got for you guys today, other than tomorrow is going to be a webinar on the front call ratio spread. We've done the front put ratio spread. We're going to do one on the front call ratio spread, and it is a slightly bullish to market neutral strategy, but if the market pulls off a little bit, we'll still be able to make profit on that trade. So you could even look to say it's even bearish to slightly bullish. So you're going to make, the reason why it's slightly bullish is because you're going to make your most money if it rallies up and pins right at your short calls. But if the market sells off, then you collect the credit that you did at the initiation of this strategy. So it's quite a nice little strategy to implement into a portfolio, especially if you're not really sure on the market direction. That's all I got for you guys today. If you can't take that, take it easy.